Good morning and good afternoon, all. Thank you for joining us for the ClearBridge Aggressive Growth and Multi-Cap Growth fourth quarter update today. As a brief introduction, my name is Rebecca Crockett. I'm the National Account Manager for Franklin Templeton, covering Morgan Stanley. Before we begin the heart of our webcast, I'd like to say thank you to all of you for your support and partnership. Morgan Stanley is a very important relationship to Franklin Templeton and ClearBridge, and we are pleased to spend this time together with all of you to provide an update. At the corporate level, Franklin Templeton completed the acquisition of Legg Mason on July 31st. Our combined firm now represents $1.4 trillion in total client assets, making us the sixth largest asset manager in the world. Franklin Templeton now is composed of 10 investment brands and an investment lineup that few competitors can match across equity, fixed income, alternatives, and multi-asset solutions. Within the equity space, ClearBridge Investments remains a leader in global active equities with $158 billion in total client assets under management. ClearBridge proven areas of expertise fall into three main styles: high active share, income solutions, and low volatility. The ClearBridge aggressive growth and multi-cap growth strategies are in the high active share area and represent $23 billion in total client assets under management. During today's webcast, we'll hear from portfolio managers Richie Freeman, Evan Bauman, and Aram Green. Our webcast is Q&A format, and we'll be taking questions via the chat feature. So, okay, on to the heart of the presentation. To begin, I'd like to introduce Bailey Davis. I'm sure many of you on this call know Bailey well, but for those who aren't as familiar with his background, Bailey is a managing director and client portfolio manager at ClearBridge. Bailey has been with ClearBridge and predecessor firms for 28 years and will be guiding today's portfolio discussion. Bailey, I'll turn it over to you now, but again, thank you to you and our PMs for joining us today.
Thanks very much, Rebecca. Thank you for that intro. Good afternoon, everybody. And today, as you know, many of you know, just over 4 weeks ago, ClearBridge made an announcement in which at the end of the 2021 calendar year, Richie Freeman will relinquish day-to-day portfolio management responsibilities on the Aggressive Growth Fund and the ClearBridge Multi-Cap Growth Portfolio. He will turn those duties over to Evan Bauman and Aram Green. Richie will remain with the firm as a senior advisor and a member of the ClearBridge Management Committee, and Aram Green will join the strategy as a co-PM on April 1st, 2021. Just to start off, Richie, I've worked with you now for 28 years, and you've made such a big impact on me, our colleagues, and many of our partners on the phone from Morgan Stanley who go way back with you to the Shearson and Smith Barney days. Can you walk us through what led you to make this monumental decision? And at the end of your comments, if you don't mind, please turn it over to Evan for some quick remarks. And if I'm not mistaken, I think you had a prediction surrounding this day in terms of what the Mets would do going forward after this decision was made. So Richie, I'll turn it over to you for comments. Thank you.
Thank you so much, Bailey, and good afternoon or good morning, everybody. I wouldn't exactly call it monumental, but it was a decision that was made. First, before I even start, I owe a debt of gratitude to all the people dialing in, all the brokers, and there were stockbrokers back in 1983 when I started this. I guess they became financial consultants sometime in the 1990s, which I guess sounds better. But really without them, our assets, which started at $123 million, never would have grown because the support that you've shown, and quite a few of you have been around for the entire life of this portfolio, which started October 24th of 1983. So I just really want to thank you. And I've started managing this thing 37 years ago, as I said, October 24th, 1983, and never really thought that I'd be holding a portfolio, holding a job for 37 years in the same place, managing the same portfolio. Specifically in terms of, if you want to call it, retiring, my father retired when he was 62 years old, so I always thought that was going to be the benchmark I was going to look at. If I ever was lucky enough to be working into my 60s, 62 was a great time to retire because hopefully by that time you will have been able to accumulate something, to be young enough and healthy enough to be able to enjoy it. 62 came and went, 64, 65. It was always, we'll do it 1 year, we'll do it 1 year, we'll plan that vacation. Never took the vacation. Ironically, we haven't taken a family vacation since before 9/11. So my wife and I were actually planning this year, we're going to finally do it, and then COVID hit. So Dad was 62, I'm 67 right now. Conversations that I had with Terrence really started more than 5 years ago, before I was 62, saying that might be a good time to make the move. But we really never did it. So specifically, what is any one thing that caused me to make the decision? I think it was early spring. I was having a catch with my grandson. While I was throwing the ball to him, on the other hand, I had my iPhone, stock quotes. I had to stop myself and said, something, this is ridiculous. This is not right. And then that was followed, I think, probably a few weeks after that. Our family doctor passed away from COVID. Those are things you can't predict. You never know. So I started really, I spoke to my wife really seriously about this is probably the time. We found that, I guess we had to stay in starting middle of March. We found that we didn't kill each other staying in the same house constantly for a couple of months. Thought that the time was right. So I spoke to Terrence Murphy about it. Evan knew about it, and it was a question of when we're going to be announcing it. But I think it really is. I think continuity is exceptionally important. You have to know that this was something that has been in the works really for a long period of time. Succession planning is something which is always very, very important at ClearBridge. It's not something we take lightly. Each of the portfolios have some kind of form of succession planning. And I think any time that you work with somebody, that basically is your succession plan. So a lot of people didn't know it, but the succession plan for this portfolio, as far as I'm concerned, started in the year 2000 when Evan joined me. He knows this after the fact. I told him I actually interviewed Evan. I was in the Rye Hilton Hotel making some kind of presentation. It was March or April of 2000. And I found him to be the smartest guy at Citigroup Asset Management at the time. Young guy, reminded me a lot of myself. And I was able to call him to try to get updates on what was happening with the biotech stocks because he understood it. He got it. For me to work with somebody, they had to share something, which bring passion for what we do. I've never viewed this, as you know, as a 9-to-5 job, actually a 9-to-4 job. When I started watching the stock market used to open at 10 and close at 3:30. Well, obviously hours have been expanded, but this has to be a job that you live and breathe more than just 5 days. You're looking how do events that are happening in the world on Saturdays and Sundays affect you, and he shared that passion. So he started working with me back in 2000. He probably didn't envision back then that he'd still be doing the same portfolio 20 years later, but that was obviously a great decision, I'm going to say, on my part, having Evan join. For years, we would be asked the question by consultants or actually by you, Richie, what if you get hit by the bus? And my standard answer was, I always say, well, you hire the bus driver. So people would laugh when I said that, and then they wouldn't ask the question for the rest of the call or for the rest of the meeting. But it really was a question of who would be running the portfolio if I were to suddenly leave for whatever reason. That, in my mind, I was always very, very comfortable with Evan. But as you know, at ClearBridge, we don't have single portfolio managers managing a product. I think you need to have more than one person doing it for reasons, as I just said, you never know. So, which leads us to how do we bring new people onto a portfolio? Well, we don't like to bring people from the outside because the best way that you can really learn about people, get a feel for them, see them, not through a job interview, but it's been seeing how they work in your department for not just a year or 2 years or 3 years, but in some cases 5 years or 10 years. I mean, Aram who's joining us, has been with us, I want to say between 2006 and 2007. It's one of those years. So it's somebody that we know very, very well. But what's vitally important to me, and I'm going to say this from a selfish standpoint, I happen to be probably one of the larger investors in the ClearBridge Aggressive Growth Fund, and I'm going to continue to be a large investor in this portfolio. So I want somebody that I can go to, when I go to sleep, I want to make sure that there are people running this portfolio that I have a heck of a lot of confidence in. I want people that I know for quite a long period of time that I can entrust my own money to, because I'm going to be a client. I'm going to be a very, very important client. I've said all along, this product is by far the largest personal holding for my family. More than money markets, it's more than houses, more than anything. This is something which has continued to build, and hopefully is going to continue to grow over time. So I have to have confidence who's going to be running it. Couldn't have more confidence than when I hired Evan back in 2000. That's clearly has exceeded expectations. As I said, I see a lot of him in me. I hope he didn't pick up too many of my bad habits. I'm afraid he has, but he has a lot of great habits he's probably learned as well. I hope he has. I think it's going to be exciting to watch how it's going to work over the next 20 years. And I mention that because it was important to have people on this portfolio that we thought could be doing this for another 20 years. You don't want to hire somebody on a portfolio that you're thinking, well, maybe this person is going to be there for a few years, retire, go someplace else. You really want to have confidence that you're going to have continuity, because that's the one thing that we've always tried to tell brokers. And we can say that we haven't deviated from that. Portfolios that have had low turnover in terms of personnel. Again, Elliot Fried and I started this in 1983. Evan joined back in 2000. I want to back up a little bit. In the 1990s, I had this young guy working with me. You probably heard of him, Peter Bourbeau. I don't know whatever happened to him after that, but I guess he went on to manage bigger and better things now. He was with me back in the 1990s again, a guy that shared a similar kind of love for this business. So we surround ourselves with people that try to emulate what we feel, and that is an extreme passion for the business and a passion for the clients. At the end of the day, you always see your clients. I've always viewed my client as being the stockbroker. If the stockbroker was happy, he'd stay with us. If he wasn't, he could always leave us. And that's the way we've always wanted to be judged over the years. So I'm excited about this. People say, how are you going to be reacting to it? First of all, I'm not going anywhere for the next year. I'm still going to be part of the firm. I am expecting in 2022, hopefully, things will be normalized. We'll take that vacation. But I think that really, were it not for COVID, we wouldn't be having this conversation right now. I think that really was the thing that it influenced me. I think it's devastating what's happened to the country. For me personally, I think it's going to be something which is necessary, and that I'll be able to be doing things that I wouldn't have done, to be able to enjoy traveling. You mentioned something, Bailey, about the Mets. Whenever people used to ask, after they asked the question about hire the bus driver, they said, Richie, when are you going to be retiring? Do you have any plans? And I always used to give the answer, I will be retiring on the second anniversary of the Mets' second consecutive World Championship. But over the years, that's looked like to be almost an impossibility. But I can now say with, I can't say utmost confidence, but strong confidence that there will be 2 consecutive World Championships for the Mets within the next 3 to 5 years. This guy can't do it. This guy can't get the Mets over the top. I really don't know who could. So that's what I want to say about the transition, how I feel about the guys taking over it. In terms of the product itself, I've always tried to be very, very honest with all of you. Never tried to be a shill for the fund. Never tried to tout when we thought things were poor, etc. It's been an incredible market year. I think few people would have expected the market to be reaching these heights in view of the situation that the country finds itself in. And I've always told people that if there's one number that you want to look at to get some kind of sense about the stock market, it's the Investors Intelligence number. I always said if that number, anytime you get less than 30% of stock market letter writers being bullish, generally you can back up the truck, even though people are going to be very cautious. Conversely, anytime that number gets over 60%, usually indicates that you have a high level of confidence bordering on euphoria edging towards the stock market. Unfortunately, you're over that 60% level right now. I'm not saying we're going to have another period like we had in 2000. I'm not forecasting one of those kind of periods. It wouldn't shock me to see the market digest some of the great gains that it's had, because this If I want to view the market of the last year, probably one of the more speculative markets I've seen. I remember 1968. I remember the market of 1999 into 2000. And this market, it might not have exact earmarks of 2000 from a valuation standpoint. You're starting to see some of the same kind of signs, which doesn't mean this thing ends today, but I think you have to be more careful. Valuation only matters when it matters. When a bull market that's cascading upwards with short covering, valuation, nothing. But one day it does mean something. Whether what we've seen over the last month, if that's just a short-term blip or more of a trend, we'll have to see that a year or two out from now. But I don't remember seeing a valuation disparity as large as what we're witnessing right now in a number of stocks that are selling at in some cases, 200 times sales, compared to other companies selling at 5, 6, 7 times earnings, throwing off cash flow. So 2000 was an interesting year in the market. I said that if we're plus or minus 2%, it would be a great year. It turned out to be a very fortunate year for us. Very difficult stock market. Not forecasting that again. That the recent trend or outperformance that we've witnessed, don't think is just it's something which potentially could grow. Because what you witnessed this year, I think, borrowed a lot from next year, borrowed a lot from the economy as well. I mean, if I go into my garage right now, I could probably drive 10 miles an hour and not hit the wall because I probably have 100 to 200 rolls of toilet paper or paper towels, and I think everybody is similar to that. You have borrowed a lot of demand from next year, so there might be some surprises that the better performing companies could disappoint borrowing from 2021. Some of the companies that have been left aside could actually start showing much better earnings progress as hopefully the economy and the world return to more normalcy. So I'm going to send this over to. I'm not going to call him a coworker. I'm going to call him a great friend. I mean, as I said, you have been a little bit before 2000, been invaluable. Probably the one I've spoken to more than anybody in the world outside of my family since year 2000. Knows me well, and best decision I ever made, and loved working with him. Will work with him and continue maintaining him as a great friend. So, Evan, let me turn it over to you if you have anything to say.
All right, thanks, Richie, and thanks everyone. I'm gonna try to fight through the tears as I talk. Look, there's not enough time on the call to reciprocate what Richie just said and go into what he has meant to me and means to me personally and professionally. And I know the same is true of many of you. As I see the list of attendees to the call, I mean, this is one big family with Jen and Lisa, our trader. I mean, we've a lot of us have been together. I still refer to myself as the new guy with 24 years at ClearBridge, but I think it's amazing how we've all been together for so long, and how, to Richie's point, I think this is so much more than colleagues or coworkers. This is a family, and it's from the day Richie referenced 2000, I remember the day he came into my office and asked me if I would run money with him, and I said, let me get back to you. I called my dad. My dad said, go tell him yes, and then deal with all the details. And that was a very lucky day in my life and my career, and it's been an amazing journey. And I think this is not the end of anything. As I said to Richie on the phone, I mean, this is the beginning. It's time to enjoy and enjoy what you've earned, enjoy really what you've built. And as I said, I think, when you look at what Richie has built in terms of the company that we work at, in terms of ClearBridge, the strategy assets, as he said, from 100 million to where it is today, well north of 20 billion. And, I think many of you dialed in. He's created enormous wealth. Hopefully I've helped, but we've created enormous wealth for many of our shared clients. I think there's Richie used the word lucky. I'm very lucky that I've been able to join you on this journey and hopefully carry it forward with Aram for the next couple of decades. And I think
instead of a lot of the questions that normally come in, there's a lot of congratulations and a lot of pride in seeing how the advisors that are dialed in really appreciate everything that you've done. And like I said, there's not enough minutes on this call to get into what you mean to me and my family and my career and everything that goes with that. In terms of Aram, I think it's similar to what you said. I mean, the last 15 years working with Aram have really been an interview. I think this was a list of one person that could join the strategy and position this strategy for success for the next couple of decades. And that's, look, you can see his track record. You can see that he's obviously an astute and incredibly strong investor, shares a lot of the characteristics that we share in terms of both being an investor, a detailed investor, and a person, a good person. And it really had to be somebody that we trusted and with whom we have mutual respect in order to carry this strategy forward. And I'm humbled. I'm really honored to be part of it. From this point moving forward, and that's exciting. I know there's a lot of questions, sure that you have about how things will change. What's most important is what we're going to preserve and embrace, and that's the legacy of the 37-year success of this strategy. And I think that's important to embrace. I think the philosophy that many of you have come to know over the decades is going to remain in place. The philosophy, the process, of course we try to get better at everything, but the idea of being long-term business owners and engaged business owners in the companies that we own is going to remain very much as you know it. I think we've always tried, Richie and I have always tried, and something he taught me is think differently. Remember, he didn't want me, when I started working with him, he didn't want me to just be another manager. He didn't want me to be a computer or somebody who just was consensus oriented. It was always about thinking differently. It's something that from the days growing up and preceding the internet, right, writing down stock quotes, very similar to Richie's childhood. I mean, that's what we've always tried to do, is think very differently than others. There's clearly a deep research bias in what we do. What about being a high concentration, high conviction manager, all of that is going to remain very consistent. So you get the output being a very high active share portfolio. Turnover is going to remain low. I'm sure there's questions about, the transition as we move forward, but think of this as remaining a very low turnover product where we focus on really separating trends from fads and businesses from concepts. So a lot of the tenets that you guys have come to know over decades, and that is going to remain true. It's like I said, it's an honor to have not only worked with Richie, but been his friend for this many years. I think this is the beginning of probably speaking to him even more than we already do, because we can actually enjoy, and I hope that Richie has the opportunity to enjoy the success that he's built. And then in terms of having Aram as a partner moving forward, I'm incredibly excited. I mean, it's still kind of day zero. It doesn't officially begin until April 1st of next year, but I think there's an enormous similarity in terms of mindset, in terms of passion for this business, and in terms of excitement that we have about trying to build this strategy as we move forward. So, Aram, let me kick it to you you can give your perspective on everything, and then we'll get into some of the detailed questions about the changes in the market and the outlook, et cetera.
Thanks, Evan. Nice to meet many of you for the first time. As Evan mentioned, I'm the new guy. I've been at ClearBridge for a little more than a decade and a half, and worked underneath Richie and alongside Evan in parallel strategies, mostly focusing on small mid growth stocks, and have learned a tremendous amount working at the same firm and with Richie over this last decade and a half. A true legend in the industry. I've appreciated his finding companies very early, being a patient investor, and managing through very tough patches. And I think, I've learned a tremendous amount. It has helped shape me to the investor that I am today. And kind of marrying that along with my entrepreneurial background. I started a tech company in the late 90s, early 2000s, took that through a couple rounds of venture capital and ended up selling that to what ended up being a NASDAQ-listed company. And so really learned a lot about cloud computing, web applications, databases, all the technology underpinnings that we're just starting to get going in the internet age, as well as what it's like to run a business and sort of all the opportunities, but all the pitfalls and hardships that come along with that. And so working internally in a business with that entrepreneurial mindset, I think, gives a different perspective and a different edge when you're evaluating businesses. And from there, I went to go work at a long-short fund, which I think also complemented the skill sets of looking at businesses from the long perspective and being a long-term investor, but also understanding how a short investor or someone who's betting against the stock would look, what characteristics they would look for in developing that negative thesis, which I think makes you sharper in being a long-term, long-oriented investor. So it's with great pleasure that I join Evan and Richie on the strategy early next year. I'm really looking forward to continuing our relationship and developing each other's skill sets as investors.
Great, thanks, guys. That was terrific. And clearly, as we transition to questions that we're getting directly from the field, Evan, you touched on it a little bit, but clearly from an expectation standpoint, clients are really curious, how this transition will look. Clearly from a capital gains perspective, that's a concern with the aggressive growth fund as we move into 2021 and 2022. What is turnover going to look like within the different strategies moving forward? You touched on it, and I think one of the things that we should talk about is that clearly capital gains in 2020 were high this year, and that was with a very low bit of turnover on the year. So maybe we can just holistically talk a little bit about the turnover, what we can expect, both Evan and Aram, and then even if we want to get into what are some of the potential subsectors that we could be invested in with the strategy going forward. Historically, we've been long healthcare, we've been long communications, we've been long tech, but maybe there's some other areas of interest that we could talk a little bit about. So I'll turn it over to you first, Ev.
Sure, thanks, Bill. No, I think I made reference to it in the first comments, but this is going to remain a low turnover strategy. It's been historically low single digits. I think that the cap gain is not about the turnover. It's clearly it's a high-class problem when you have low basis stock in the portfolio and you have to sell when clients want their money. And that's more what the recent cap gain was due to than anything else. I have, similar to what Richie discussed, I have every dollar that I have invested in the stock markets in this strategy. So we're obviously sensitive to taxes. Taxes are a good problem to have, but they're also again, a high-class problem when you have low basis stock. But I think that's importantly, the key to moving forward is continuing to evolve and making sure that you own the best businesses for the future. And so turnover is really the byproduct of your philosophy and your process. And I think we would never put a number on what we expect the turnover to be, but you can look at the funds that Aram has run have historically been very low turnover strategies. This has been probably the lowest turnover strategy in the marketplace, and we expect going forward, when we think about time horizons and long-term investing, the goal is to benefit from compounding of growth of free cash flows. And so turnover is going to remain low. Will there be some period where, for the next couple of years, will it be higher than average? It could be as we transition the portfolio slightly. But again, that's not changing the portfolio. It's not changing the key sectors that we're invested in. I think the question you asked about sectors and subsectors, goes to the fact that historically, those of you who have known the strategy since the early 80s, we've had investments in healthcare and media really for the life of the strategy. We've been invested quite heavily in technology, not the big stuff, but some of the disruptors within technology. And I think we'll get into some of the details on some of those stocks as we move forward. But clearly, we have, the majority of the investment is in three areas right now. It's healthcare, media, and tech. I think Aram clearly brings, some expertise in other areas that we might not have heavy exposure to, and that's areas like e-commerce, consumer, some other disruptive companies that are idiosyncratic in sectors we don't own. So, yeah, I mean, the answer to your question is I think the strategy will continue to evolve. As I said earlier, I think the key is preserving the philosophy that's been successful for nearly 4 decades, but making sure that you own the right companies for the next decades. And that is best way I can say. It's going to remain low turnover. It's not going to be zero, but I think the issue of cap gain this year had nothing to do with this discussion. And certainly, again, as big individual shareholders in the strategy ourselves, we'll be aware of those issues.
Great. Well, with that said, clearly I'm going to throw a slide up for the group here and this is slide 3, in talking about market concentration. But Aram, clearly with the strategies that you manage at ClearBridge, the Select Fund is one that comes to mind, which is available at Morgan on the UMA platform. You've obviously been a big investor within Select in some of these disruptive types of companies, and they've clearly been big winners this year in terms of the market backdrop. Maybe just a quick kind of thought in terms of how are you looking at that space today, as it has had a big move in the market, clearly. And then after that, I'll get into some areas of interest from the portfolio side, and then going forward on the healthcare and technology side.
So you astutely point out that there's been a huge move on the stock prices of these companies, and in some cases, a lot of multiple expansion. And I would say that it's hard to generalize whether that's justified or not. We tend, as stock pickers and focus on our companies, to do that, to be paying attention to our companies and what we own and what valuation and what we think they're worth in the long term. And so we still feel like there's a lot of runway for additional revenue growth and leverage in the operating model that's not being factored into today's stock prices and in our companies. But clearly that's not the case for the growth market in general. There's been a tremendous amount of inflation in multiples, and you're seeing a lot of speculative activity, particularly post the election, in some of these areas like new storage for electric vehicles, Bitcoin, et cetera. Not to call out any one of them in particular, but you're definitely seeing a lot of just speculative action broadly. So, as a very concentrated, active manager, we are employed to go find those opportunities that are underappreciated, that have long runways for growth, self-funded growth business models, where there's an entrepreneurial mindset at the management team that's investing today for future growth, in developing the existing markets that they're in and expanding into new markets, and that the profitability of these companies is underestimated. And so that's where we're focusing our attention today. And I think it just goes back to finding those companies before they become mainstream household names, where they're still underappreciated in terms of their market size and the power of economics that these companies are going to have. So we still are, even though I'd say that there's been a lot of inflation in multiples and valuations, and there is a lot of speculative activity, that doesn't mean that there aren't great investments to be deploying capital into today, and that's where we're positioned.
Terrific. Thank you. If we transition a little bit more to the portfolio, Evan, clearly when you look at this year, it has been a crazy year, but there have been some key winners in the portfolio that kind of touch on what Aram was just going through with his analysis. And CRE, you've talked about, this holding. It's been a long-term holding. one of our mid-cap names. And, maybe you could give a little bit of a sense of the transition this company has gone through, really from a LED-led company to a silicon carbide EV play, like Aram talks about.
Yeah, it's funny. I mean, we've owned it for 18 years, so it's a newer name for us. But half joking, I think here's a great example of the success of this strategy, in that very few of the names we own today look exactly like they did when they were bought. I mean, when Cree, as you said, when we sourced Cree, it was a leader in LED backlighting. It transitioned into a general lighting play, and then it took really a new CEO to take a look at the set of assets they had and realize the opportunities for growth for the next 10 to 15 years at a minimum are really their Wolfspeed division, which is their silicon carbide and gallium nitride materials and power chip business. They've become a leader in a obviously rapidly growing end market of electrification of vehicles, but they're also gaining significant share because silicon carbide is replacing silicon in a lot of these EVs, including the big names in Europe and Asia, where you have a more cost-effective technology, it's more energy efficient, and they not only are supplying the raw materials, but they're also now making devices of their own. So you're talking about a company with a $10 billion market cap today with a near-term pipeline of $10 billion in the power chip area, power device area, which is enabling converters, inverters, power stations that are all going into EVs. So it's just a good example. Like I said, you guys know the strategy. You know that many of the companies that we own today have really evolved their businesses over time. But here's a name that we've owned for almost 2 decades, which is at the very early days of a massively growing addressable market in the EV space and silicon carbide. So it's important to continue to continue to review the portfolio. That Cree's an example of that. Nuance is another one. We've had a lot of companies that have gotten better over time by either transitioning the way that Cree has, or just continuing to evolve. So that's it's funny. You don't always have to find the next great thing if you already own it, and that, I think, in many cases in the portfolio has been true. Nuance spinning off Cerence, which is a leader in automotive speech recognition, another example where those have been some of the best stocks this year, ironically, have been names in the technology space. They're not the FANG stocks, but they're mid-cap technology companies that have refocused their business and have seen, again, new waves of growth for the next decade and beyond.
Great. We've gotten some questions on the system just as it relates to COVID, and clearly 2020 has been a crazy year. And when we talk about the pandemic and all the changes that are occurring to the way we live and work, are there themes that you guys feel that really have staying power? Evan, I know you and Richie have talked about this modern day Manhattan Project that we're witnessing right before our eyes in healthcare and the speed at which it is occurring. So, Evan, I thought it might be a good time just to kind of comment on healthcare. The portfolio has always had a large, big allocation to healthcare. And just kind of knowing that you invest in companies, not the sector, can you lay out some of your thoughts on the upside case there for healthcare? And then, Aram, with your strong background in technology, clearly this portfolio has had a large allocation to tech, focused on different areas. But maybe you could allude to some of your bigger thoughts on tech as it relates to post-COVID. Thank you.
Sure. So, starting on healthcare, I'm going to tell you that I'm a little surprised the sector hasn't performed better this year. I mean, for a number of years, there was obviously political risk. There was fears around, contracting drug prices. The sector, many companies in the sector had almost become vilified. They'd become villains in terms of raising drug prices. And then you get into an environment like this with a healthcare crisis, of which, as you made reference to, Bales, you've had really remarkable progress in less than 1 year from identifying a novel novel virus that was really unknown when we came into this year, to finding therapeutics and vaccines and bringing to market in a record short amount of time a solution, or at least the beginning of solutions to this crisis. And I think that from a long-term investment perspective, as many of you know, I mean, Richie bought Genentech in 1983 as the first stock ever purchased in October. So we've had clearly interest in the healthcare sector for a long time in terms of therapeutics, and that remains the case today. I think in some ways, you look at the names that we own, there's clearly a renewed focus on rare disease and big unmet needs like neurology, with companies like Vertex, Ultragenyx, which has done a great job in the rare disease space, and a number of the other names that we own there that are finding, in many cases, first-in-class treatments for large global unmet needs. But I think looking forward, if there are lessons learned from COVID and from the global healthcare crisis, I think you need to continue to invest. And I think this is talking multi-decade long investment opportunities, investing in diagnostics, right? Preventing a future recurrence of what we're going through now with analytics, boosting the supply chain in the U.S., particularly preventing future crises by identifying diseases early and really early detection of many different diseases. When we speak to United Health Group, which we've owned since 1992, and it was a sub-billion-dollar company in terms of revenue, today, I guess this year they'll do about $280 billion from $600 million at purchase. They talk about areas of growth like analytics, like telemedicine. Again, I think bringing down overall cost of healthcare with low-cost primary care centers. I think those, in terms of the next legs of growth, you look at areas like liquid biopsy, for example, which is able to detect early on the best therapy selection for cancer patients. And longer term, we see opportunity for being able to detect disease before it's too late, or too late in a patient's degradation to have efficacious treatment. So remains a big focus. We clearly love the IP aspect of the healthcare companies that we own, being able to not only be first to market, but in many cases be the only company to market the way that Vertex has been in the CF market, and then continuing to move forward in the clinic with treatments for rare blood disorders. They had data recently in terms of gene editing where they're partnered with CRISPR, and a number of other areas which are rare diseases that impact the liver, the lungs, the kidneys, and many other inherited rare genetic disorders. So as you move towards, for therapeutics, more value-based pricing, where companies that can improve outcomes and improve the lives of patients, and then early detection of disease through new technologies like Guardant Health, what they're doing in liquid biopsy. I think those are really some of the areas that we're focused on moving forward in the healthcare space. And like I said, I think the big political risks seem to be off the table in terms of major structural change. And you want companies that continue, again, like a UNH, which moved from being a 100% commercial insurer to really a very diverse, technology-oriented and scientific-oriented company today, evolving to continue to grow double digits in the future. So it's remains a key focus for the portfolio.
Great. And Aaron, I don't mean to limit you to technology. I know there's other areas surrounding tech. I think of fintech and things like that, but maybe you could offer some of your thoughts also.
Yeah, so I think that that we have uncovered innovation in a lot of areas. Fundamentally, we feel that every company needs to be a technology company. It's just how you remain resilient, competitive in today's environment. If you're not investing in technology, in the security that wraps around that and the other building blocks, then you're going to fall by the wayside and not be competitive with those that are. So I think fundamentally we're just looking at every company and understanding how they're utilizing technology to their advantages to advance their product capabilities, their interactions with customers, et cetera. And so I think that's just something that cuts across every company, and we're finding innovation in a number of different industries. But some of the ones that we've touched upon and expanding on them are things like digital payments, e-commerce, and how customers are interacting differently with major brands and purveyors of products, and sort of the shift in terms of the technological landscape to rapid development at the software development and operations layer within an organization. So we think that the opportunities are pretty broad in terms of some of the trends that are underway that have consistent legs to them, and it's about finding the right business with the right balance sheet and the right management team, and then trading at an attractive valuation that makes sense for us, taking our capital and the capital of our clients that's been entrusted to us to deploy that capital at attractive valuations where we can say that there's 2 to 3 times the upside versus the downside. So we think that there's a lot of opportunities, and they are pretty diverse in terms of the different industries and the different end markets in which they play into. So we're casting a little bit of a wider net to go look for those opportunities.
Great. I know we're bumping up on time here, but I just want to make sure we answer all questions. And Aram, just for you, one of the questions that has been coming up is just from a time management perspective. Is being a co-manager with Evan on the multi-cap aggressive growth strategy, is that going to take up too much time as it relates to Select and some of the other strategies that you manage at ClearBridge? So how do you address that time management?
So I actually think that working on this strategy is better for investors in Select as well as the aggressive growth investors. There's a dual beneficial effect in the fact that we have a pretty wide lens in terms of the kind of companies that we're looking at, and we're also augmenting the resources that support our efforts on the PM level. So on the Select mid side of my responsibilities, we have 3 dedicated analysts. We're going to be adding a 4th analyst. We've also been investing in the research team at ClearBridge and continuing to expand the number of analysts that support us in developing new ideas and maintaining names in the portfolio to make sure that the thesis and the investment framework is still there. And so I think we've got a big, growing, broad team that allows us as portfolio managers to find additional leverage. And I think one of the benefits of looking at small mid-cap stocks as well as large-cap stocks is it makes you sharp in terms of understanding some of the ankle biters and disruptive players that are coming up from the bottom in the companies that you currently own, as well as getting an early jump on some of those companies that are small working their way up that might be interesting investments in the portfolio. So I don't see any additional pressures on my time. It's not a conflict of interest. All the strategies I manage have a growth bias to them, so focus more on growth businesses and companies we think are going to be substantially bigger in the future and generate lots more cash flow and be much more highly valued in terms of their overall market valuation. And so I think there's commonality in what we're looking for, as well as a philosophy to be long-term investors that's been consistent really across ClearBridge, but ever so across the strategies that I manage. These are relatively low turnover, long-term oriented strategies that focus on finding those great businesses run by entrepreneurial management teams that have a long runway for growth. And it's finding those companies early, investing alongside them, and then watching the years of compounding revenue and profitability drive that stock price higher.
Great. That's super helpful. Well, from a closing comments perspective, Aram, Evan, clearly we've been through many big events together, like 9/11, Hurricane Sandy, where, lives have clearly been disrupted. And now we've been doing some equivalent of this work from home now for 9 months due to the pandemic. And I guess in a few words, what will you remember most about this year, and how do you think it impacts you as investors really going forward? Evan, if you want to kick it off.
Yeah, I mean, look, we've been through other events. You mentioned 9/11. We've been through stock market crashes, credit crises, economic events. I think that obviously what makes this one unique is the healthcare crisis aspect of it. I think it's touched all of us from a personal perspective. It's caused us all to take personal inventory and realize what are your priorities in life. So I think that's the biggest thing that's different about this. And again, I think the economy, look, we believe right now that you're still going to have a lot of volatility. I think, as Richie referenced, I think we're all surprised at how rapidly the stock market rallied back to all-time highs without any kind of major correction or test or pullback. And the key takeaway for me in terms of how it impacts you as an investor goes back to something that Richie taught me in the mid-90s, which is you never know what's going to come your way as an investor. You want to own great businesses. You want to make sure you don't overpay for them. But the key tenet, the number one thing, if I've had one takeaway, it's own companies that can survive during difficult times. When everything's going up, it's one thing. When the economy gets difficult, we used to say if the stock market were to close for a period of time the way it did after 9/11, or the economy were to close the way it did this year, you want to own companies that can survive that. And frankly, you want to own the businesses that, because of strong market positions and liquidity, can emerge stronger and better. And I think that is look, again, I still call myself the new guy at 20-something years. I think that's a lesson that works regardless of the environment. You want to own cash. You want to own great companies. You want to own, those businesses and not overpay for them. And if you do that, we're not always going to be maybe number one, but I think this is how we've kept the investors that we've held for decades, and hopefully we continue to do that moving forward. So look, as I said earlier, this has been humbling for me just to even hear Richie's words earlier. I'm proud. I'm humbled. I'm excited for the future, and hopefully many of you are on the journey with us going forward. But right now, it's about making sure, especially at the holidays, you're either in person or virtually with your families, and you have perspective on these times that we've been through. Hopefully, there's better times ahead. So that's all I have to say about that.
Great. Aram, if you have some thoughts, thanks.
Yeah, I mean, I think the things that, as Evan pointed out, not much different, just a reminder of sort of what we've experienced in the past in terms of market volatility and shocks either in the stock market or the economy, is to maintain an open-mindedness about how things will evolve, and don't be dismissive, but yet always work from a skeptical framework of challenging your conviction, your thesis, and what management teams tell you. Really have an independent opinion, which goes back to something that Evan mentioned early on. Don't think like everyone else. Have a differentiated view and think independently. And the fact that things can evolve and devolve very quickly. And so as a consequence, investing in these forward-looking management teams that have the robust, strong balance sheet, because you just never know what's going to happen. I think this year is a good indicator of that. You want to be in companies that you're comfortable owning for a very long time. If the market shuts down, if they go through a rough patch, et cetera, and you're investing alongside the right management teams with the right balance sheet that can ride out a difficult environment or whatever gets thrown their way, knowing that these management teams are focused on the 3, 5, 10-year objectives that they laid out to conquer their market or expand into new markets. And so I think if you use that framework and don't get jostled by, the headlines, that's a long-term winning scenario. And I think that's just, those are something that we've experienced before, and those are kind of ingrained in Richie and Evan in my mind. But I think what we just lived through this year really solidified that and proved out that case.
Terrific. Thanks for tying that together. And thank you guys for all your comments. I know we're bumping up on the hour. So this is Bailey. On behalf of ClearBridge, really we want to wish everyone a happy holiday season. Clearly thank you for all your support, and please stay safe, everyone, as we go into 2021. Rebecca, I'll turn it back to you. Take care, everybody.
Thank you all for your time today, and thank you for those of you who've dialed in. Please stay safe and healthy, and wishing you all a happy holiday season. So again, thank you and have a wonderful day.